if you could only own one ETF for the next 20 years? If I told you that you could only own one ETF for the next 20 years, which one would you choose? VOO, QQQ, SCHD, or maybe the entire world through VT? By the end of this video, I'll tell you exactly which one I'd choose. And it's not the one with the best returns. Most investors already have an answer, and that's exactly the problem, because everyone seems convinced their ETF is the best. Open YouTube, and you'll find people saying the S&P 500 is all you'll ever need. Open Reddit, and they'll tell you to buy VT and forget everything else. Talk to dividend investors, and they'll swear SCHD is the smartest choice. Growth investors, they'll argue QQQ has already settled the debate. So, who's actually right? Can one ETF really outperform the others for the next 20 years? Or are we asking the wrong question? Because choosing an ETF isn't just about chasing the highest return. It's about choosing the investment. You'll actually have the discipline to hold through recessions, market crashes, bear markets, and maybe even another financial crisis. By the end of this video, you'll also know which ETF has historically delivered the strongest returns, which one has been the most resilient, which one I'd recommend to someone in their 20s, which one I'd recommend to someone approaching retirement. And when I give you my final answer, I think it'll surprise you. Let's meet our finalists. Before we can decide which ETF deserves a place in your portfolio for the next 20 years, we need to meet our 4 finalists. At first glance, they all look similar. You buy one fund, hold it for decades, and hopefully retire wealthier than when you started. But underneath the surface, they couldn't be more different, because each one was built to solve a completely different problem. Let's start with the most famous one, VOO. VOO tracks the S&P 500, 500 of America's largest public companies: Apple, Microsoft, Amazon, Nvidia, Google, Meta. The companies that millions of people interact with every single day. Instead of trying to pick tomorrow's winner, VOO simply owns the biggest businesses in America. It's simple, low cost, highly diversified, and for decades, it has quietly become the benchmark that almost every investor compares themselves against. If someone says, "I beat the market," they're usually talking about beating VOO. But then there's another ETF that believes being average isn't enough. QQQ. QQQ doesn't try to own the entire market. It concentrates on innovation, technology, artificial intelligence, cloud computing, digital advertising, semiconductors, companies that have transformed the way we live. Historically, that focus has produced incredible returns. But concentration always comes with a price. Higher highs usually come with deeper lows. We'll come back to that later. Now let's meet the favorite of dividend investors, SCHD. SCHD isn't chasing the fastest growing companies. It's looking for something completely different. Businesses with long histories of paying dividends, strong balance sheets, consistent profits, reliable cash generation. Think of SCHD as the investor who cares less about excitement and more about getting paid. Year after year, market after market. It's built for investors who appreciate stability without completely giving up growth. And finally, there's the ETF that's probably the least exciting, yet one of the most diversified. VT. VT owns almost everything, not just America, the entire world. Thousands of companies across developed markets and emerging economies. Instead of betting that one country will dominate forever, VT makes a different assumption. Nobody knows what the next 20 years will look like. So why bet everything on one market? Now here's what's interesting. Each of these ETFs solves a different problem. VOO asks, what if America continues leading the world? QQQ asks, what if innovation keeps winning? SCHD asks, what if quality and dividends matter most? VT asks, what if nobody knows the future? And that's why choosing between them isn't nearly as simple as comparing returns, because the ETF that made the most money isn't automatically the best ETF to own. To understand why, we need to see how each one has actually performed. The performance test. Let's play a game. Imagine you invested exactly the same amount of money into each ETF. Same starting date, same monthly contribution, no market timing, no buying the dips, just disciplined investing. Which one do you think would finish first? Take a guess, because the answer is probably exactly what you'd expect. QQQ. Over the past 2 decades, few broad ETFs have generated returns like the Nasdaq-100. The explosion of companies like Apple, Microsoft, Amazon, Nvidia, and now artificial intelligence has rewarded investors who stayed invested. If our only objective were maximizing historical returns, the conversation would already be over. QQQ wins. Let's put real numbers on the table. Over the past 10 years, QQQ has averaged close to 19% a year. VOO has averaged around 15%. SCHD has averaged around 12%. VT, since it launched in 2008, has averaged closer to 9% a year. Here's what that looks like in dollars. If you invested $500 a month for 20 years, at QQQ's historical rate, you'd end up with roughly $1.4 million. At VOO's rate, around $756,000, at SCHD's rate, around $526,000. At VT's rate, around $322,000. Same monthly contribution, same 20 years, a gap of over $1 million. Based on nothing but which ticker you picked. On paper, QQQ wins by a landslide, but investing isn't a history exam. It's a real-life decision, because here's the question almost nobody asks. Could you actually live through the journey that produced those returns? Because every spectacular rally came with moments that tested investors' patience. Moments when headlines declared, technology was finished. Moments when portfolios lost enormous value. Moments when millions of investors sold. Right before the recovery began. That's something performance charts rarely show. They show the destination, not the emotional cost of getting there. VOO tells a different story. Its returns haven't been as spectacular, but they've been remarkably consistent. Instead of relying on one sector or one trend, it has grown alongside the broader American economy. SCHD takes another path entirely. Historically, its total returns have been competitive, while also paying investors a steadily growing stream of dividends. It may not dominate during speculative bull markets, but many investors appreciate what happens when markets become uncertain. Then there's VT, the most diversified portfolio of the 4. Its returns have generally been lower than funds focused entirely on the US, because it also owns regions that have gone through long periods of slower growth. But in exchange, it offers something the others can't. The confidence that your future isn't tied to the success of just one country. So, if QQQ produced the highest historical return, why wouldn't everyone simply buy QQQ? Because returns are only half the story. The other half is what happens when the market crashes. And that's where this comparison becomes much more interesting. The ETF you can actually hold. At this point, most people think they know the answer. QQQ made the most money. Case closed, except that's not how investing works. Because the best investment isn't the one with the highest return. It's the one you can actually hold. Think about it. Imagine buying an ETF today and promising yourself, I won't sell for 20 years. Sounds easy. Until your portfolio drops 20%, then 30%, then 40%. Every news channel tells you the market is broken. Your friends stop investing. Social media is filled with predictions of another Great Depression. That's the moment that decides your future, not the bull market, the bear market. History has shown this over and over again. The investors who build wealth aren't necessarily the smartest. They're the ones who stay invested when everyone else is running away. And every ETF makes that challenge a little different. QQQ asks you to believe that innovation will continue changing the world, even after brutal corrections. VOO asks you to trust that America's largest companies will continue adapting, just as they have for decades. SCHD asks you to focus less on your account balance and more on the cash your investments continue generating. VT asks you to accept that no single country will dominate forever, and that global diversification is worth sacrificing some potential upside. None of those philosophies are wrong. They're simply different ways of dealing with uncertainty. Because uncertainty is the one thing every investor is guaranteed to experience. Visual: calendar pages flipping quickly through 20 years. Now here's something interesting. Most people spend months researching which ETF has the highest historical return. Very few ask themselves a much more important question: which ETF would I still be buying? After my portfolio falls by 40%, because that's the ETF you'll probably own 20 years from now, not the one with the prettiest chart, the one you trust enough to keep buying when everyone else is selling. And that brings us to the final decision. If I could only own one ETF, which one would I choose? My decision. Let's make one thing clear. This isn't the only correct answer. If you're 25, your answer might be different from someone who's 60. If you're building passive income, your priorities will be different from someone chasing maximum growth. And that's exactly why this question is so interesting, because every ETF asks you to make a trade-off. QQQ gives you incredible growth potential, but asks you to accept higher volatility. SCHD gives you growing dividend income, but may not keep pace with the fastest technology rallies. VT offers unmatched diversification, but sacrifices some upside in exchange for global exposure. And then there's VOO. If someone told me, you can never buy another ETF again, VOO would probably be my choice. Not because it's the highest performing ETF. It isn't. Not because it's the safest. It isn't. And not because it pays the highest dividends. It doesn't. I'd choose it because it offers something incredibly valuable: balance. It owns the companies that have consistently adapted through technological revolutions, financial crises, pandemics, inflation, and changing economic cycles. It doesn't depend on one industry. It doesn't depend on one investment style. It simply owns the businesses that have historically driven the American economy forward. Could another ETF outperform it over the next 20 years? Absolutely. Maybe QQQ, maybe something that doesn't even exist today. Nobody knows. But investing isn't about finding certainty. It's about making the best decision with the information you have today. And for me, VOO offers the best balance between growth, diversification, simplicity, and the confidence that I could continue holding it through almost any market environment. Not because it's perfect, but because I believe I could stay invested for 20 years. And in investing, that may be the greatest advantage of all. But here's something even more interesting. What if choosing only one ETF is actually the wrong question? What if combining VOO with just one more ETF, something built for income like SCHD, could give you better diversification, more monthly cash flow, or even a smoother ride through the next crash, without making your portfolio more complicated? That's exactly what we'll build in the next video. The 2 ETF portfolio that could beat owning just one. So if you're serious about building wealth that lasts for decades, make sure you're subscribed. Because here, we're not looking for the perfect investment. We're building a better investor. Remember, a little wealth built consistently can become financial freedom.